key inflation gauge watched by the U.S. Federal Reserve, also rose again in March. The core personal consumption expenditures index, or the PCE, which excludes food and energy, was up 0.3% from February. That's 4.6% higher than a year ago. Wage growth, another measure the Fed watches on the inflation front, was also up 1.2% in the first quarter from 3 months before. And this all looks like that the Fed will raise rates again next week, and possibly by a 0.25 percentage point. The central bank has raised rates thus far 9 times since March of 2022. And for more on how the markets closed out the session, here's John Terrett from the New York Stock Exchange.
What a week on Wall Street it was, with GDP coming in at 1.1% midweek. Now, that's far lower than had been anticipated at 1.9%. But do remember, the consumer, hiring and corporate earnings all remain very, very robust. It all points to a 25 basis point increase in the rate here next Wednesday when the Federal Reserve makes that decision. Also this week, big tech doing the business. Good, strong earnings from Microsoft, Alphabet, Amazon and Meta platforms. And we said goodbye to Bed Bath & Beyond, which is filing for bankruptcy protection. They'll soon be gone. A much-loved chain of stores, because that's the place that has kitted out 1 million student dorms when they go away to university, and probably even more first homes for couples preparing to start a family. On the markets, well, it was modest gains, I'd say, and the Dow and the S&P were up for the week and also for the month. The Dow was ahead by 0.8%, the Nasdaq 0.7%, the S&P 500 0.8% on the day. And in the week to come, a busy week, more earnings. On Wednesday, we get the Federal Reserve decision on interest rates at 18 hours GMT. And on Friday at 12:30 GMT, it's the government jobs report for the month of April. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
For more on Wall Street and the rest of the markets, Otaviano Canuto, for a senior fellow at the Policy Center for New South, also a former VP at the World Bank. Good to see you. This has been a very strange week. On one hand, we've had fairly robust earnings, at least on the tech side. Then we had this concerns about inflation. We had the PCE number come in a little bit, I think, less than welcomed to the markets in terms of getting inflation under control. And then late today, we had this banking thing has reared its ugly head again with First Republic Bank, which is a very, very large, I know they call it a regional bank, but it's actually a fairly large banking institution. And the market seems to be taking all of this in stride.
It's true. I would say that the case of the First Republic is a new chapter of the banking stress that we saw in March. Basically, it has a couple of things in common with SVB. Of course, the Silicon Valley Bank was an extreme case of vulnerability because they had a huge degree of concentration of their assets in fixed rates treasuries that had become phased out vis-a-vis the ongoing interest rates, and also the uniqueness of their deposit base, their base of depositors, where a small group of large depositors able to shift their money by simply using.
You know what I'm worried about, though? You know what really, really worries me about this is the fact that big banks gave them $30 billion, right, after the collapse of SVB.
Yes. Yeah.
And in the last report, they said they lost $100 billion in deposits. So that's a drop in the bucket. And essentially, if you take $100 billion out of any institution, that's a very significant amount. On top of that, the Fed and the banking regulators have been trying to find a buyer, find a hero to save the bank. It's been weeks and weeks and weeks, and nobody wants to touch it. That it doesn't make sense if there are assets there. Nobody wants to touch it because nobody wants the potential losses. Isn't this a failure of the regulators and the system itself to save itself?
Now, the degree of exposure of these banks relative to this kind of so-called duration risk, that is to say, the possibility of mismatch between returns in assets and liabilities, is something that definitely appeared to be broader than the case of the Silicon Valley Bank. That's for sure. And it's not by chance that the downfall this week followed exactly the announcement by the First Republic Bank that they were thinking of, like the SVB tried, to sell off some assets in their so as to cover the exit of $100 billion. And it definitely $100 billion of assets to be sold with losses because of the market valuation.
Well, in fairness, the Fed already says you can take toilet paper to the Federal Reserve and they're going to give you par. In other words, they're going to give you $1 no matter what you can bring a broken phone into the Federal Reserve and they're going to pay you the full price of what a brand new phone is. So that should have solved that problem. But let me switch gears a little bit, and I want to continue this thought on why can't we have, and I don't know if you agree with this or not, if the FDIC just said, look, the $250,000 limit, increase it to $500,000, increase it to $1 million. We did this after Lehman Brothers collapsed. Why can't the FDIC do this today? We have an implicit guarantee of all the deposits at every single bank in America. Make it explicit. Make the guarantee $1 million. Why don't we do that?
That will need Congress. See, that's a step, because what Janet Yellen and the authorities have resorted to was the appeal to systemic risk. There is always some arbitrariness in defining when the situation is systemic or not. But the fact of the matter is that one thing is to make the announcement on a specific case. Before making it, in order to make it an overall rule, definitely this would have to go through Congress. And Congress is not much friendly, as you know.
That's a whole other conversation. I want to touch on the economy very quickly with you, where next week we have a big decision on the interest rate. I think some are expecting a quarter point raise. Many are arguing if the bank collapse, don't raise. I mean, we've done enough damage to the economy in the short term. The long term, there's a huge question mark, right? The Fed wants to slow the economy down because they want to slow inflation down, but it really hasn't worked to the extent that they've wanted it to work because the economy is, for lack of a better word, too strong. It seems to me we've got two economies in America.
But at the same time, Phil, take into account that the banking stress in itself has already clearly had some effects on the credit creation. We don't have, as of now, a credit crunch in the sense that the collapse of credit, but you do look at the signals of the lack of issuance of bonds, the tightening of credit standards, and so on. So there is already in course an effect through the tightening.
Are you saying the Fed should not raise rates then?
Well, I would say that the 0.25, the 25 basis points, might do it. You know, it's symbolically still a continuation. But my personal bet, is that that's what the Fed will decide on Tuesday and Wednesday. Lift it more, 25 basis points, put it 5 to 5.25. And expect that the already tightened monetary conditions, together with the tightening of financial conditions that I referred to, might do the job of decelerating the economy enough. And they will stand by. I guess it is a myth that, as some market analysts are betting, that the Fed would feel obliged to reverse.
I'll tell you what, look, we're running out of time, but if this bank, First Republic, collapses this weekend, I think the Fed would be absolutely stupid to raise rates in the face of what we're seeing right now. It can't be any more obvious to anybody who watches the markets that you got a problem here. But that's just my opinion, Otaviano.
Even though, Phil, it's not going to be 25 basis points in addition.
Right.
That would make such a difference with respect to the already existing.
I apologize. We're out of time. It's good to see you. Have a good weekend. Thank you.
You too.